Last week, the Federal Reserve held their annual meeting at Jackson Hole, which is basically, it's like a big get-together for the Fed. It's kind of like Burning Man, except at the end, instead of burning a giant effigy, they burn the economy. Okay, look, I'm not that negative. I mean, if you watch my videos, you know I'm very positive about what's going on. Keep watching and you're gonna see what's going on here. But first off, let's go over and talk about what happened at the Federal Reserve's meeting. Check out this headline from Reuters: Fed officials see U.S. interest rates rising further. So the influential chief of the New York Fed said that the central bank will likely need to get its policy rate somewhat above 3.5% to keep it there through 2023. And right now it's around 2.25 to 2.5%, so it's definitely going higher. The CNBC article says that Fed's master sees benchmark rate moving above 4%, so even higher than the one we saw before, and no cuts at least through 2023. From this headline from Fortune, you can see the stock market is plunging and the Fed is giving up on a soft landing in favor of a growth recession buckle up. So basically, there's this whole thing about maybe the Federal Reserve was going to do this Fed put. And basically, it was going to be like a soft landing. They're going to make sure that the economy doesn't basically get hurt too much as they rise interest rates, as interest rates rise, as they increase their policy rates. And so throughout the whole summer, this is what we saw basically in the stock market. The stock market was up because the stock market thought that the Fed was probably going to give some type of soft landing. Now, after Jackson Hole, that whole thing's pretty much out the window. No one really thinks that that's going to happen right now. Basically, a lot of people, or the market, let's say, thinks that there's going to be some pain ahead because that is what the Federal Reserve Chairman Jerome Powell said in a press conference. Okay, so what does all this mean? Why do we care about this? Okay, so first off, we know that interest rates are very important for the economy, right? So higher interest rates mean that it's harder to borrow money without paying like lower amounts of money, right? So if I take an interest on a loan that's at 1%, like 2 years ago, let's say, versus today, and let's say my loan's 5%, right? I'm just making up numbers. Well, I'm going to have to pay a lot more money to take a 5% loan out than a 1% loan out. And that's basically what's going on. The Fed is increasing interest rates slowly, little by little. And as they do that, basically it's getting more and more expensive for people to lend money and markets react. What's very interesting about what's going on right now is that this has not been a normal environment to do this for a very long time, as you can see here from this tweet from Charlie Bilella. Charlie says, during the past 8 bear markets, as you'll see up here, these are the different bear markets, 1987, 1990, 1998, and so on. These were the Fed chairs, so Greenspan, Bernanke, and we had Powell, right? So these are the different time periods. These are the Fed chairs, and this was the Fed's response. As you can see from all these time periods, basically what they did was they had rates that were pretty high, 7%, and they dropped them to 6.5% because there were issues with the economy, right? There was maybe a recession. They wanted to stimulate the economy by lowering interest rates. But right now, the economy needs to actually increase interest rates. So it's doing the opposite of what it's done over the past 8 different bear markets. And so we're in a very weird time period. Potentially, we're in a recession right now. However, the Fed's actually increasing interest rates, whereas in the past, they usually are decreasing interest rates in a time like this, right? So we're in a very weird economy, a very weird situation, and that's just the way it is right now. Things have been kind of weird for the past, let's say, 10, 15 years. We've had very low interest rates, negative interest rates essentially, and that's had an effect on markets, and markets have overheated, and now the Fed is stepping in to try to quell what's been going on, which is basically rampant inflation. So I thought this tweet was really interesting, and it says, Ray Dalio's Bridgewater, so that's the world's largest hedge fund, says that stocks will drop another 25% on the Fed's quantitative tightening. And that's something I haven't really talked much about in the channel here, which I'm going to do some more videos on. But basically, the Fed is going to start tightening. So they're basically going to be getting rid of assets. So the Fed has all these assets on their balance sheet. They're going to start essentially throwing them out into the market. So before, when they were doing quantitative easing, what they were doing was they were buying assets. They're doing the opposite. So basically what they're doing is going to be more harsh for the economy, right? So they're doing this while they're increasing interest rates. There's a lot to kind of look at what's going on with the Fed right now. Very interesting, kind of scary if you think too much about it. But let's not get too scared. But this is Ray Dalio. I don't know, he's with P. Diddy. I thought that was funny, thinking about P. Diddy and Ray Dalio just hanging out. That would be interesting. So that's what Ray Dalio's Bridgewater said. So the next thing I have here is another kind of doom and gloom thing. Okay, too much doom and gloom maybe for this show. But we have Michael J. Kramer here. So this is the S&P 500, which is in the yellow line here. And the yellow line is basically the S&P 500 back in the Great Recession, right? So when things really went downhill, So that's what it's showing here, the stock market during the Great Recession. And it's overlaying it with today's stock market. So it took 2 time periods, basically from April 25th of 2006, and it goes to July 18th of 2008. That's this yellow line. And then we're looking right now at the S&P 500 up until the 25th of August right here. And what you're seeing here is that basically this is like mirroring what's going on, right? The market today is mirroring 2008. And what happened in 2008? Well, there was this last leg down that kind of really just nail in the coffin type thing. And then after that, bounce, market went back up, and then it never went back down to those levels. And so the question is this going to happen? Because it's been so correlated, I don't think it's going to. However, it's interesting to see, and maybe it will happen. So if it does happen, we have a big drop that would be coming. I don't think it's going to happen, but if it does, there's a big drop coming. In general, charts like this, where you kind of like take 2 time periods and overlay them, I think it does get to the point where you can do it with almost any asset class. At some point, things line up, but it is kind of scary. So I figured I'd throw it out here, but again, I don't really necessarily think it's going to happen, but it's all over Twitter, so figured I'd share it. Okay, no more doom and gloom. Doom and gloom is out. Throw it out the window. Let's talk about some positive things. Okay, we're looking at the different bull and bear markets over the past 90 years. This is from Markets and Mayhem Twitter account. So look at the duration, and we have the different price changes, how much the prices have gone down and how long it took, right? So over here, we see over 5.1 years, there was a negative 60% in the market. So lots of pain, obviously not a good time to be invested. And, the economy at that point in time, it was a really rough time for the entire country, okay? But the war happens, World War II comes around, and suddenly we have this wartime economy engine that's driving us out of this depression. And we have a 4.1 years where we have 158% gain in the markets, right? So you had this long depression type time period, and then you had this kind of decent time period where things were just going crazy, and then you had another 3 years where things went down 30%. And you go through these different cycles, however, they get shorter as time goes on. So what you're going to see is that there were no, in more modern times, let's say after 1950s, there were no more time periods where you had long, let's say 3+ year recessionary periods where the market stayed down a lot. This one in the 1950s was only 1.2 years, down 22%. This one over here was only half of a year, that was down 28%, right? After that, 3.6 years, up 80%, right? And so what you see is, you see these kind of small little giant dips, right? So things go down pretty quickly. And it's not, of course, it's scary when things go down 36%. But then you have these time periods after that where the market really does rebound and go up from there. And that's kind of what we see over time. You have these little kind of short-term little blips where things go down, but you have longer-term periods where things go up, and that's why the market's usually up over time, is because, on average, the market's up a lot more than it is down. So if we look at the worst time period since the Great Depression, that would be the Great Recession. And the Great Recession, negative 57%. So obviously it was a really bad time to be in for everyone in the economy, investing. Everyone was hurting at that moment in time. Down, it was 1.4 years that this was going on, and then after that, we had 10.9 years of gains, 401%, until we hit the next recession, which was in 2018, which was only 0.1 year, right? A very quick, very negative 34%, but very quick, and then we had a rebound up for another year and a half until COVID hits, and it's down 24%, and here we are today. So what I wanted to do is get across in this whole thing is that these little things, they don't last as long, historically speaking. They don't last very long. They go pretty quickly, especially in more modern times. The longest one in recent memory has been about 2.5 years. So we're at 6 months right now. So let's give it another year and a half. And it's likely that this is kind of all behind us, and we'll see what happens, because we are, like I said, in a kind of interesting environment where the Fed is actually increasing interest rates going into a recession. So it could be different. But historically speaking, I think that this is something that gives a lot of people some confidence. And maybe if you're really concerned about this whole thing, I hope that this kind of maybe brings you a little bit of, maybe comfort, right? And so I hope that that helps a bit. The last thing I want to talk to you about is the fact that there's this interesting thing that's going on that was talked about a few weeks ago. And so this is another one from Goodby. I don't know if that's how you pronounce this guy's Twitter handle, but he says, Bloomberg says this indicator has a 100% track record of calling the bottom. So whenever in a bear market, the S&P 500 closes above the 50% Fibonacci retracement, I'll show you in a sec what that means, it has marked the end of every single bear market. So again, we're in a kind of crazy period, rising interest rates, going into potential recessionary environment, but for every time this has ever happened, this has signaled the end of the bear market. So what's this mean? This is the S&P 500, and we're looking at the top over here, which is around early January. And so what we're doing is we're saying, okay, we're looking at what's called a Fibonacci retracement. So you draw a Fibonacci retracement. So here you take the top of this area where the market topped essentially. I'm not going to be extremely accurate, but I'm just going to show you what this essentially looks like. So we draw down to the bottom. And so from the top here to the bottom, we see the different Fibonacci retracement levels. And the retracement is when it hits this bottom, when it retraces and goes back up to a certain level, okay? And so what we're doing is we're looking at this 50% level, and that's this area right here. And basically, as you can see, the market went above this 50% retracement, and every single time that this has ever happened in a bear market, it's never gone back down and bottomed again. So essentially, it should not, if this never happens again, which again, we're in historically kind of unprecedented times, but if it doesn't happen again, it should not go back down under 3,600-ish, okay? That's the deal. Now, of course it could. It could definitely. But maybe it gives you a little confidence that this has never happened before in a bear market. It would be historically unprecedented if it does happen. So let's see if it happens. In the meantime, you know what? Prices of stocks are on sale compared to where they were just a year ago. So basically, if you want to invest, go ahead and invest. It's a great time to probably get into the market over the long term. You can buy stocks cheaper now than they were before, and maybe you can do a good job, make some money over the long run. So that's all I have for this video. Hope it helps. Hope it gives you a little bit of confidence about what's going on. And if you like the video, hit that like button, subscribe to see future content like this, and please watch another one of my videos coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.